Lance Lambert, welcome to the Groundfloor Market Trends podcast. How are you today?
Good, Patrick. Thank you so much for having me. It really means a lot. I'm ready to talk housing.
Absolutely. We love doing that here at Groundfloor. So Lance, you recently took over CEO and editor of ResiClub, along with a Groundfloor investor, actually. What is your take on ResiClub and how it's going to impact the housing data and sort of narrative?
Yeah, so I had been at at Fortune magazine for 4 years. I was the real estate editor when I left. I'd been a data journalist and a financial journalist at places like Bloomberg and Realtor.com. And so I left to found this niche news and research publication just focused on the US housing market. And we want to be people's data-driven gateway to the housing market. And so we are passing through what could be one of the most significant chapters ever for housing. And we've seen affordability deteriorate so quickly, so fast. We've never seen something quite like this in terms of the speed of the deterioration. And so we're just a publication that's trying to get through the nuance of this market and kind of help people to understand it. Because right now, on one hand, take a sector like mortgage, right? They're in a severe recession where purchase applications are way down because affordability is strained by the lock-in effect. And then refi is also deep in the dumps because people with 2, 3, 4% mortgages, they're not going out to refi for 7. And so, and then you flip it and you look at single family home building, and yeah, while there's a few markets where maybe sales are down a bit, on a national level, single family home building has been fairly resilient, all things considered. And so I'm just trying to get through the nuance of the market, help people understand it. And then I really have a geographical and regional lens through my work, because at the end of the day, so much in housing can vary so much across the country.
Absolutely. And we're not only sort of partners on the survey that we're about to talk about, I'm also a subscriber. And, for my job at Groundfloor, which is, head of market risk, I'm constantly looking for new ways to look at data, interesting observations about the data. And I think basically the emails every day that we get on the newsletter, have absolutely helped us. I'm a big proponent of ResiClub. I thought you've done a great job, making the data stand out and bringing new insights into the market. So just want to give you some compliments there. And I know, we service both, home flippers, home builders, and the investors that sort of invest into the debt that we provide. And all of those sort of clients would have use for sort of ResiClub's data. So I really think that you guys are onto something there, and have enjoyed it so far. And so one of the things that we got together and did is this Groundfloor ResiClub, or I guess it could be ResiClub Groundfloor survey too, but I think I'm going to call it the Groundfloor ResiClub survey. And that was sent out in the middle of June about. So why don't you go through sort of how that came about and how you went about sort of parsing the data and some of the questions involved, and then we can go through each question one by one.
Yeah, so ResiClub's audience, which kind of varies between a lot of single-family landlord investors, that's an audience that I've cultivated over many years. There's a good number of real estate agents, some buyers, sellers, a lot of smart data people across the industry like yourself, and different executives throughout, flipping and home building and all of that. And so we came together to create a survey to go out to these single-family landlords, because they're not really an audience that gets surveyed much. We don't really know what they're thinking. There aren't many publications that are geared to just single-family landlords. Yeah, there's bigger pockets, but not doing this type of analytics to find out what the landlords are thinking. And so we came together with this questionnaire. We sent it out to a lot of my audience, the single-family landlords in there, and we got over 200 responses. And we got enough that we were able to break it down for Midwest, Northeast, Southeast, Southwest, West, national. So we have a lot of great data, and I'm really excited to get into the results here.
Yeah. So just as piece of information. I don't know, we're heavily concentrated in the Southeast as far as our lending portfolio goes. So I know our audience on the investor side and the borrowing side will be particularly interested in how the Southeast played. Now, we're a national lender. We lend in 31 states. So we touch in all these geos and all these regions, but the Southeast is, where my eyes go first, for sure, just because of our, exposure there. And we're happy to have it there, actually, for a lot of good reasons. So just want to start with that. But so this first question is about a very important new, topic that's getting sort of a lot of attention, deservedly so, and that's about how concerned housing investors are about future home insurance premium hikes. So Lance, why don't you go walk us through some of the results here?
Yeah, and so what we found out is that around 80% of single-family landlords that we surveyed are concerned about future home insurance premium hikes, and around 35-ish% are very concerned. And at first glance, you might think, well, that makes sense. It's probably all in Florida, or it's all in Texas, or it's all in California. But what's interesting about the data is it's in the Midwest, it's in the Northeast, it's in the Southeast, it's in the Southwest, it's in the West, it's everywhere. They're concerned about home insurance premiums. And I think what that gets to is the fact that, at least through my reporting, is that the increases in home insurance, yes, there is definitely a component that is climate risk, and especially, in like Southwest Florida after Hurricane Ian in September 2022, third costliest hurricane ever. So that was a shock to the insurance market.
Yep.
But I think big picture, what's occurred is that in the economy, we had an inflationary shock and a housing/construction inflationary shock that was even bigger than the inflationary shock. And what that means is that U.S. home prices are up a tremendous amount, and that the cost of construction and the cost of repair and the cost of replacement is very high, right? And so when there is damage, it's more expensive now to do the same repairs. And so there's a lag between that occurring and the overheating and the inflationary shock, and then that getting into the insurance market. And so I think what we have been seeing over the past, let's say, 12 to 16 to 18 months is finally that moving through the insurance markets. And so between 2018 and 2021, 4-year period, there was only one state that ever saw a home insurance premium increase over 10% for the average premium during a 4-year period. And it was in Florida, not surprising. Yeah. But last year, 2023, there were 25 states that saw at least a 10% increase in the average home insurance premium, according to S&P Global. And so we are seeing that shock move into the market, and it's everywhere. It's happening all over the place because the cost of construction and the housing inflationary shock has happened across the country. Now, some of that is getting slowed down by, state commissioners who could be political appointees who kind of have an interest to kind of slow down those shocks. But we are very much seeing that pass through the housing market right now. And I think it makes a lot of sense that it has investors on edge.
Yeah.
And the thing about it is, when you look at the overheating on home prices or the mortgage rate shock, that didn't necessarily have a huge impact on most single family landlords. In fact, they made money on the housing inflationary shock, right? Yeah. If they owned. And the rate shock, most of them have fixed debt. Now, some that do have variable debt, a little bit of a different story. But insurance is one of those areas, just like property taxes.
Variable, yes.
Big jump. That's an immediate hit to your cash flow.
There it is. Yep.
So I have a friend who purchased a rental, his first ever rental in Fort Lauderdale during the pandemic housing boom. And at the beginning of this year, his average monthly payment went up around $600 a month because of property taxes and insurance. Now, it's a very expensive property, but that's an immediate hit to cash flow. And he was not able to raise his rents even $1 because the tenant, kind of fought it. And so it was just right, a straight hit to cash flow.
Yeah, and it's this, to your point, this whole affordability question equation, which you just walked through, and this is just, another component, recent component for sure, that investors, single family investors, commercial real estate investors are going to sort of be dealing with in the future. So I think, the culmination of sort of the last 18 months with showing these premiums just shows that, going forward, the real estate investors that we lend to understand they have to bake these costs in, right? And that there's a new normal, right? And that is, it's interesting. And that's why keeping track of data is important, right? You go back, it's not just hurricanes, it's thunderstorms, right? It's tornadoes, it's drought. Drought's probably the biggest component of climate change. So all these things, sort of have culminated with things like labor shortages, supply shortages, supply chain shortages that, really have, made the last couple of years, somewhat difficult relative to, costing out projects for sure for our investors. So, and then we see that in the owner occupied world now where, certainly home prices have been stable, but home sales, that's where we really have seen recessionary type numbers. So yeah, let's move on to the next one. How housing investors expect home prices to shift in their core market, and this is where the sort of the regions become very important. How shift in their core market in the next 12 months. Why don't you walk us through the results?
Yeah, and so before we get too much into the survey data, I should note that the Southwest in our methodology includes Texas, it includes New Mexico, Arizona, that's kind of the Southwest market, and then the West is kind of up to Colorado and then over. Yep. And the Southeast is pretty much Virginia, West Virginia, Kentucky, and down. And then Pennsylvania, of course, is over to the Northeast. That's kind of
there's a really good map of that on your site, and I can get that into the description of this somehow too. So we'll make sure that we do that so people can have the visual too.
I think the biggest thing to note is just that Texas is in the Southwest.
Right.
I think one that kind of throws people. And so what we see in the data here is that the most bearishness is in the Southwest and a little bit in the Southeast, and that's probably parts of Florida and parts of Texas where we've seen resale inventory move up fairly quickly over the past year, or really 2 years. But zoomed out, most of these investors still think that home prices are going to go up a little bit in their market. And that's true in the Midwest, Northeast, Southeast, and even the Southwest and the West. And so 55% think nationally.
Are you surprised by the bullishness in the West? The West, 61%, 1 to 5% increase.
So what's been interesting in the West is that of all the housing markets in the country, in the first 6 months of the mortgage rate shock in 2022, when we very quickly went from 3% to 7%, it was actually the West, not the Southeast, not Florida, not as much some of these other parts of Texas. It was true in Austin, but not all of Texas. But it was in the western part of the country where we saw the most give up in price initially during the rate shock. And my view of that is that the Western housing markets, because of an acute shortage of housing, have seen, and other factors as well, including, the robust growth of tech over the past decade, has seen home prices relative to local incomes become very stretched, right? And so when the rate shock occurred, that affordability for a brief period of time just got too far out of whack for people. Where it was like, okay, people were already stretching themselves so thin to buy in Los Angeles, San Francisco, Seattle, that when the rate shock occurred, they pulled back a bit and prices fell. But very quickly, entering 2023, those Western markets stabilized very fast. And so Los Angeles, for example, in Southern California, they saw an immediate recovery almost in home prices, and the give ups in the second half of 2022 were wiped out very quickly. And I think the big picture there is, while they saw some give up in price in the second half of 2022 in those Western markets, their fundamentals in terms of, or their technicals in terms of active listings remained very low, that the market just quickly stabilized, is my view. And so we still see a good amount of stabilization out West. The exception being some pockets of the Mountain West where there was, kind of that big Zoom town effect
Mhm.
from home, kind of really stretched fundamentals. But otherwise, you are still seeing prices rise in most of the Western markets right now on a year-over-year basis.
Not only has it been resilient, but the outlooks. I mean, you look at those who are forecasting, right? Um, the outlooks have been this 1 to 5% range, right? Pretty consistently. I don't know about you, but I catch myself in amazement a lot about how resilient prices have been. We understand fundamentally why that is, right? And we'll probably talk about some of the reasons going down, but it's really, um, maybe I saw your you talked to Bill McBride in a recent newsletter that you put out or he put out, and you were talking about what sort of housing market from the past this looks like, and you identified late 70s, early 80s, which was super interesting. But what is your take on how resilient home prices has been? I hate to go tangentially, but I think it'd be a good time to talk about that.
Yeah, so I was a bit surprised that we didn't, at least, I didn't think there was going to be a GFC give up, right, in
Right.
price in like second half of 2022 into 23. But that second half of 2022, which I covered, that give up that happened briefly there, I thought it would have extended more into 2023, and then we would have a weaker spring season and that then more give up into the second half of 2023. That's what I personally kind of viewed would happen. I didn't come out and make big calls on it because, I try to cover this more as a journalist and a little bit less of an analyst and independent thinker or independent, journalist who gathers a lot of these other calls. And so if I'm going to gather a lot of the other forecasts and calls, I don't want to be making too many calls myself or else I kind of seem biased. But that was my personal view, as I thought maybe there could be more give up. And very quickly in 2023, the market stabilized into what was still tight technicals in terms of there wasn't a lot of active listings, right? That lock-in effect had kind of really decreased the amount of resale churn occurring. There isn't much resale turnover because people don't want to give up a 3% mortgage rate for a 7%. And and then as a whole, homeowners are in, fairly good situation relative to some past cycles, right? We went through a tightening of lending standards. And so the people who are left have much higher credit scores who've gotten in. And so I think not having that distress in the pool of homeowners, which isn't really something I thought would occur, but that has really stabilized the market because there isn't distress sales, or not very many. And so, we just stabilized very quickly. Whereas I think some of us thought maybe because affordability got so strained so quickly, deteriorated so fast in 2022, that maybe, we could see more give up. We didn't see that in 2023. And then into 2024, on a national basis, home prices are still rising and still up in most markets, although there are some exceptions in and around the Gulf areas.
Yeah, we definitely noted. So, we fund loans for, individual house flippers and small builders of new homes. And we really saw a difference in the way they were looking at buying starting in the spring of really 22 as interest rates really started to go. So we noticed that, in the type of deals that were coming in. We also pulled back on our lending guidelines in summer of 22. What surprised me the most was you had this pretty robust increase in inventory in the summer months of 22, while the picture of rates became clear, right? And you had this run up of inventory, and then it really slowed down. And that slowdown, I guess it shouldn't have surprised me, but I was kind of expecting inventory to get sort of out of hand. It did not, clearly. And so that was an interesting. It was interesting to see how our buyers reacted to the changing environment. No one's had an interest rate environment. We had a brief one in 18 where they went up a little bit. But no one's had an interest rate environment like that in probably 4 decades, the pace at which those interest rates increase. So
And that is actually the fastest pace ever.
is it ever? Is
Ever,
it?
ever,
Mhm.
yeah.
Yeah.
That's the thing. It was, the market started, it was destabilized for a brief period of time. We had a 5-6 month correction. And if you sustain that for a few years, you would have a really sizable give up. But the market just stabilized very quickly,
Yep.
despite that affordability stretch that, was
Yep.
historic in terms of its speed of deterioration. And so I think the market just kind of, because the technicals of the fact there wasn't the distress sales, the fact that, homeowners at large, the people holding the asset could kind of, take their time selling it. I think
Yep.
that all like stabilized the market
Yep.
into this very low level of active inventory, which is
On
building
the
a bit.
rise now, a little bit on the rise now, but
Little
not unexpected. I think everyone
Not the
expected
speed
it.
of 2022.
No,
That's
nowhere
2022.
near.
Most of that now.
Absolutely.
Steady.
Let's look at housing investors' expectations, how single-family rents are going to shift in their core market. So in the next 12 months. So we're
This
talking about housing prices. Let's talk about rents.
this is arguably the most important aspect of the market for investors, because right now there's fewer homes on the market for sale that cash flow, right? Because rates have went up so much, prices have went up so much, and and if it does cash flow, it's maybe not where investors want it to be, right? And so if prices aren't going to come down, the thing that could put the market closer to equilibrium and make this more enticing of a buy would be higher rents on the single family side. And we are seeing single family rents continue to rise nationally. CoreLogic has it closer to like 3.5%, 4% year over year. Zillow has it around 5% year over year. It's really right around where we were pre-pandemic, right? We went through a big overheating. It went up dramatically. And then, they never fell nationally, although there's just a couple of markets like, Punta Gorda or Cape Coral or Austin that are down for single family rents, but most markets still continuing to rise. And when you look at this, the most pessimism is kind of some parts of Southwest. I'm guessing that's really Texas. But even there, still around half expect them to be up at least, 1 to 5%. So, it's not bearishness, but it's not like super bullishness either.
Right. And it's a little bit different than multifamily behaving a little bit. I think there's more pressure on to the downside on some of the markets in multifamily, just as a comparison. But I would say that 50 to 55% of the exits of our loans, are to hold the properties. So they're flipping out of our loan into a long-term loan, right? And you saw a good amount of institutional capital ready to fund that, right? So, there's definitely capital, in the market to, finance those, long-term, 30-year rental loans. So I think which is also having the availability of capital there in the market, even in some uncertain, right? You could look at the market with some uncertainty that the capital is theirs. I think to some extent, part of this story that what this says right here for sure. And again, look at the West, the optimistic West, Lance. Very, very. I don't know if that's surprising, but it registered the highest, in this for this particular question for sure.
Yeah, it's interesting. Yeah. Now, I do think it's interesting, though, to also note that there's not as many markets that expect, over 5% appreciation. Nationally, only 6% of the, more than 200 investors expected that for their core market. And it's also worth noting that we asked them about their own market, where they personally own the most rentals.
Yep. And so that was in the Midwest. Is that right? The Midwest had the highest number of those who were the most bullish. Is that correct? Am I reading that right?
Yeah, but at the end of the day, because of the margin of error, it's not too much more than the West or
You don't
national.
think that's significant?
Yeah. But
Absolutely.
yeah, the Midwest.
All right. Housing investors describe the U.S. housing market. So I'll let you walk through this one and some of the results here.
Yeah, and so most of the investors that we surveyed, when you add it all up, it's around 90% that say the U.S. housing market is underbuilt. Only around like 9% say it's somewhat very overbuilt. And so why does that matter? Well, it could matter because the fact that despite all of this deterioration in housing affordability from the prices side overheating, from the construction costs going up, from the insurance, from the rates more than pretty much tripling, the fact that the market has been able to absorb that could speak to the fact that there's still, the secular underbuilt cycle for single family housing. Now, it's worth noting that we asked about the U.S. housing market. We didn't ask just about single family, and we didn't ask about multi. And so, I think your CEO has kind of pointed this out where, hey, maybe the housing market isn't as underbuilt as people think. Maybe it's more underbuilt for, affordable single family housing, because right now on the multi side, some of these markets, they have a lot of supply going in that's not necessarily getting absorbed or is having to see, rent cuts to get absorbed in the multi side. So I think that's worth noting. With the audience of single family landlords, and I'm guessing that a lot of them probably saw it through the lenses of single family.
Yeah, for sure. And yeah, some of those demand drivers, I think what Brian was pointing out in his article, some of those demand drivers, he wasn't necessarily arguing with it underbuilt, but he was just saying, are we looking at all the demand drivers, right? It was very thoughtful, and we certainly are here. So,
and if anybody hasn't read that, I would recommend reading it. You could read it on ResiClub. Just Google Groundfloor CEO Brian Daly's interview with ResiClub, and I'm sure it'll pop up.
Absolutely, yeah, it was a great contribution there. And then so we look at new construction is 35% of our business, roughly, of new loans that go out, and whether we're undersupplied or oversupplied, it's probably not going to change that percentage of the book. I think it's probably less undersupplied than we think, if you want my personal opinion. And I did have some impact on Brian's thinking in his article, but I for certainly see new construction as a growth area for us, because you do have, however supply is looked at, you do have an aged housing stock, and that's certainly I think is pretty well demonstrated. So we feel very bullish about the aspect of the housing market, needing renovations or to be redone and newly built. And we love urban infill projects, right, where it's one lot or two lots. And so, we're comfortable, with the supply questions, because our projects tend to be very focused in on specific areas, right, where we have good local market knowledge before we go into it. And our investors that invest in those securities sort of, benefit from that sort of, us wedging in locally. So this is a great question, though, and it's always very interesting to debate or discuss, for sure. There's so many components of it that you need to look at. It's like, for people very interested in sort of in housing and the data that drives it, this is a great question. So anything here that surprised you, or is this about what you thought was gonna?
No, I think that it's pretty in line with what I would have guessed.
Yeah, absolutely.
Okay.
Next question: how concerned housing investors are about natural disaster and weather-related property damage? So take us through this one.
Yeah, was a little surprised here that it is very similar across the country. I think a part of that could be that, while some of these places in the Northeast, or maybe even the Midwest, while they might not on an aggregate level have a ton of natural disaster risk, some of them do, right? Some of them are in flood zones, or some of them are in these areas that could be affected, or they're kind of worried about, like, the Hurricane Sandy's, right?
Mm-hmm.
One thing that I wish I would have done on this one is asked how concerned housing investors are about natural disaster and weather-related property damage to their homes.
Hmm.
I think that's one thing that could have helped us a little bit because we don't see a ton of regional variation here. We do
Yeah.
see more so in the Southeast. That was totally expected. But it is a little bit surprising that like the Midwest is the same as the West. But it is definitely a concern, but nothing too surprising on this one.
Yeah, and that question will probably different if it's hurricane season or not hurricane season for sure, unfortunately. And I think that I went to a climate change conference where they were discussing weather patterns and weather models and things, and there was a lot of discussion around insurance costs. And what was interesting is that I think that when we see natural disaster, we think of we really think of large scale flooding, hurricanes, or tornadoes, but lightning, thunderstorms are a very big influence to sort of this question. And I think people don't necessarily, they obviously, when you say it, they sort of get it, but I don't think it's the first thing that comes to mind. But that's something that really affects everywhere.
Now that you say that, yeah, there's been tons of windstorms around here where people have had to like get new. I'm in Southwest Ohio,
Okay.
Cincinnati area, so we don't have a lot of the bigger natural disaster type stuff. But every once in a while, some like wind damage or from like ice storms.
Yeah, absolutely. Or when the Bengals lose, right?
Yeah, don't get me on that. Point.
Okay, what housing investors say their biggest concern is for the single-family housing market over the next 12 months? Great question. Not surprising at all to me. I think this speaks about interest rates, but go ahead.
Yeah, this is exactly what I thought it would be. Higher for longer being the top concern. One thing that's fascinating is we were just talking about the fact that, how much resiliency home prices have had given everything that's happened. But could you imagine going back to 2021 and telling people not only would rates go to 7%, but that in the middle of 2024, we would still be there?
Right.
We have very much kind of been at, what would have been then seen as the worst case scenario for rates. And so we're still there. It's still very much a huge concern for investors and really just across the housing sector. Even the parts of the housing sector that have been resilient, it's still, a big question for them because it affects their profitability levels. It affects, returns on capital and all of that. So it makes sense that it's the highest. It's interesting that economic and unemployment risk is so low.
Really? Because
You
that's been the traditional driver in real estate, right? It's jobs. Yeah.
Yeah, and even rising property taxes over it,
Mhm.
and rising home insurance premiums. So if you take that with the property tax,
Yeah.
that's to 15, 16%. But still, I think, yeah, I think it makes sense. But I am a little surprised that the economic and unemployment risk is so low in terms of what people put is what is their biggest concerns in the next 12 months. Not because I'm saying that I personally am super bearish on the economy, but
Right.
we did pass through what was the fastest rate hiking cycle in 4 decades.
Yeah.
And in the real economy, we saw the fastest ever increase in the rates. And then, we are at the tail end of that. We're kind of getting to where the Fed's like, starting to focus a little less on the inflation mandate and a little more on the employment mandate. So, a little surprised that more people didn't put that higher.
I mean, I'm sure that you saw his comments yesterday when Chairman Powell's comments in front of Congress yesterday. He basically said, yeah, we note the progress. We aren't totally convinced yet. And just as you said, we're looking at the employment resiliency and the unemployment rate. But the market, saying the market generally relative to how it's measured in probability and bets in the market, you can see what about a 70% sort of favorable opinion that rate, that Chairman Powell will lower rates in September. I just have to disagree with that. I'll take a position on that. I don't see that happening. I mean, I don't know how much is baked into that number. It gets widely circulated. I look at FedWatch Tool as my reference point, just for disclosure, but it's very interesting. I feel like he's very, he made it clear that higher for longer is where we are. And I think you almost have to, as a lender, as an investor, as an analyst, as a gatherer of data, you almost have to expect that that's what's going to happen, right? And it's very interesting. But I just have one question about this. Let's say that we're back in the rate environment post pandemic, where it was 2-3% mortgages. What's the number one answer on this? If you take out interest rates, where do you see, would it be employment? Would it be?
So, and I have a hard time answering that, because if we're in a world,
it's a trick question.
Rates have gone that low, something really bad has happened.
That's
right?
true. That's true.
So if we're in that low of a rate environment, this employment and unemployment fear would be much, much higher.
Yeah.
But if you're asking, that one's, it's a tough one, because if you go back to, let's say, 2 to 3 years ago, when we were in that really low rate environment, I think most people would have answered the biggest fear would be rates going up, unemployment, and then I think the other thing is they probably would have put much higher home price correction risk, because at the time home prices were going up so much, and we hadn't gone through the period that we have now. And so there was a lot more of like, what will happen to home prices once rates go up? We do know now, because we've been through it.
Right.
There's a lot more resiliency. But back then, I think people were a little more concerned on the correction risk.
Yep.
And also just the fear of rates going higher and what that could mean for the economy too. Because
that's a great point. I mean, there was some glooming and dooming in the summer of 22 for sure, relative to how big the price correction is. Very locally, places saw that. As you said in the earlier slides that we were looking at, for sure. Though, what a great question though. It's always interesting, how the macro outlook is playing out as to how this answer is.
And before we change slides, let's keep in mind this says 12 months.
12 months. It's the next year, right?
Absolutely. Now let's go to the next one.
Okay.
10 years. Okay, looking really far out. Maybe I should have done 5 years on this one, because 10 years kind of gets to start to be really far. But
you make people think about it, though. I mean, I think it's a decade's a good amount of time.
Yeah, exactly. And then some of them get to be slightly redundant, because then it's like, well, the economic unemployment risk, how can you really think about that 10 years out? But I do think it's interesting, though, to see strained housing affordability being so high on the list and undersupply. I think that, a lot of people, at least we're surveying, are kind of seeing a market where, they don't necessarily see a lever down in some ways, or at least super quickly in terms of affordability. And I think the second answer, being undersupply, is probably a part of that.
Yeah.
Climate risk is fairly low, and insurance a little lower than I would have thought. Higher for longer at that point, that's so far out that one kind of doesn't make as much sense. But I do think it's interesting, though, that so many just picked strained housing affordability.
Well, I would have to agree with them. I think higher for longer is going to last for a while, and I think affordability questions are going to remain, unfortunately. But I think locally to Groundfloor and our platform here, you can buy and sell homes and invest in homes and in really any market, provided how well you buy it, right? And investors can invest in first lien debt of well-chosen projects. So I think that I'm speaking personally here. I do think affordability would have been my answer too, although I would have probably definitely ranked the last one higher, climate risk. Just because I've been going to seminars, and as you know, in our space, we're seeing a lot more of talk about that, right? So I think I think I'm rightfully thinking more about it relative to, how
Well,
we risk at
and
ground.
and so I think another answer that could be the same thing for that is rising home insurance premiums, where we
It
have
is.
7% there. But I
Yeah.
am a bit surprised that rising home insurance premiums isn't higher. Now, maybe
Right.
some people who picked strained housing affordability are kind of like picking a lot of these things where they're like, oh, prices, maybe they're going to keep going up and not really have a lever down. And maybe rates will stay longer for, a longer period of time than expected. And maybe also this climate risk and home insurance premiums with more upward pressure. Maybe I should have given them the chance to like make multiple selections.
Yeah. Well, there'll probably be a next time, right? So, let's keep
That's a
that.
good point. If we continue to
Yeah.
do this together
Yeah.
over time, we'll get to see interesting changes in the
Absolutely. We need to compare different macro environments too, for sure.
exactly.
Okay. Let's see here. How many see one? How likely housing investors say they are to buy another investment property over the next 12 months? So what is their near-term plans? How did this pan out?
Yeah, so 58%, which is interesting, said they're either very likely or somewhat likely to buy another investment property over the next 12 months. So, despite everything, despite rates being so high, despite prices being so high, despite construction costs being so high, most of these active single family landlords still plan, or at least hope to, it sounds like, buy another property over the next 12 months, which I think is interesting. And that's really the case almost across the board, a little lower in the Northeast, but not really enough to where you could make much of a conclusion about it.
Yeah, I think portfolio, you know, you investors tend to want their portfolios to grow unless they're for some reason, downsizing it. But this is, I think there's an expectation here. I think that more inventory will be available to get buys at. I think that expectation is inherent in this result, for sure. We hear that a lot talking to our investors that we lend to. That the anticipation, especially at the beginning, the anticipation was that inventory will grow this year, that there'll be more opportunities to buy it at the proper numbers, right?
Yeah.
So yeah, I think that leads to some of the bullishness that we see here. I this panned out just as I thought it would. I think I probably could have guessed this pretty right. Although I'd have thought the Northeast might have been a little heavier on the bullish side, but
Hmm. Well, again, it could be a little bit of noise because it's
sure,
not
for
much of a
sure.
big difference.
Yeah. All right.
Also, the one thing about the Northeast is they have the lowest level of supply, and
Mm-hmm.
resale churn is so low there as well that maybe just the selection, right?
Mm-hmm.
Those
Yep.
markets have stayed so tight. And if you're a single family buyer in the Northeast, you don't have as many of the new construction options, right? Whereas if you're in the Southeast and you're a first time home buyer, you could go to these home builders and not only, have options, but maybe some of those concessions, like the mortgage rate buy downs, kind of draw their attention. In the Northeast, you don't have that.
Right.
And then the fact that those buyers are competing with the single family landlords probably discourages some single family landlords, given how competitive the Northeast has remained through this whole rate shock period.
And so the next question relates to housing investors say how likely they're to sell any of their investment properties over the next 12 months. And I see my eyes go right to the Southeast of 52%, very unlikely. What do you make of that?
I think a part of that is probably the bullishness on the Southeast, right? It's going to be a place where there's going to be a lot of single family SFR growth, right? It's just going to happen. You look at the demographics, you look at the potential outlooks for rent growth. It's where the population is growing. So that all makes sense. Nationally, only 32% of the single family landlords we surveyed plan to sell any of their investment properties over the next 12 months. A part of this is we do have some flippers in here too, so
Mm-hmm.
that increased the numbers a little bit. We didn't subset them out.
Oh, that's a good point. Yeah.
So, nothing that's eyebrow raising about this data. And, this happens. where, some investors are buying, some investors are selling. The numbers don't look in any way eyebrow raising.
I would, if I had, the access to the providers of the answers to this, I would ask this question every month just to see if it's changing at all. It's a great indicator, great leading indicator, right? You're not going to see the sales until they occur, but if you have the intentionality, shift in these numbers, I think that would be a pretty cool leading indicator to, to act upon.
I think that's the value of this ground floor investor survey over time.
Yep.
Is if we continue to ask, let's say 6 of these questions continuously, we're going to get some really great market pulses. And then every once in a while, throw in some other questions too.
Yep.
That are kind of timely. But yeah, I think the strength of this analytics is only going to get stronger over time, the more that we run it.
Absolutely. And I look forward to reading those reports when they come. But Lance, I think that we've reached the last slide in the survey that we had sent out. And I just want to, say thank you for spending some time, on the Market Trends podcast today. And, look forward to working with you in the future, Lance. Thank you very much.
Patrick, really appreciate it. Housing, always willing to talk housing, and really excited with everything that you're doing over at Ground Floor.
Thank you, Lance. You have a good day.
Okay. Is it over? Oh, sorry.
Yeah, we're good.
Okay. Hopefully I didn't get in there with the, is it over?
It's okay. We're going to